Welcome to the Deep Dive, the show where we take the sources you share with us and provide the intellectual shortcut, extracting the key insights and strategic nuggets you need to be truly well-informed.
Today, we're opening up the playbook of a corporate giant. I mean, a company whose products are really in every facet of our digital lives.
That's right. For so many of us, the name Dell is just synonymous with personal computing. You know, that reliable desktop or laptop that got you through college, or maybe the one that runs your accounting software right now.
But the story of Dell Technologies today, the modern company, it isn't really about simple hardware. It's a story about a dramatic corporate resurrection. It's about a jaw-dropping financial gamble.
And the largest technology acquisition in history. We're talking about the $67 billion bet Michael Dell made.
A bet that came with a mountain of debt and the incredibly complex financial engineering it took to bring this new behemoth of a company back to the public market.
So our mission for this deep dive is pretty clear. First, we're going to map out that convoluted road to the merger. We need to analyze the pressures that drove both Dell Inc. and EMC Corporation into this massive union.
Right. And then we have to spend some real time dissecting the mechanics of the deal itself, that $67 billion deal. Specifically, how on earth did they manage the colossal debt burden that came with it?
And finally, we'll define the two core business divisions. Analyze their strategic pivot toward things like AI and edge computing.
And we really have to start by just acknowledging the staggering scale here. To understand why this transformation matters, you just have to look at the vitals.
Let's do it. The records we have indicate that for fiscal year 2025, Dell Technologies reported revenue of, $95.6 billion US dollars?
An incredible number. And that places them at 44th on the most recent Fortune 500 list, which is based on those 2024 revenue numbers. So you see, this isn't just a successful company. This is a foundational pillar of the global IT infrastructure.
But the path they took to get here was anything but conventional. It required this period of radical isolation, which I think brings us perfectly to our first section.
The road to the merger and the unique pressures that really define the destinies of both Dell and EMC.
So when most of us think of Michael Dell and his company, we probably picture the IPO back in the 90s, the explosive growth, the, total domination of the PC market.
Right.
But the story that led to this massive EMC merger actually begins with Dell kind of retreating from the spotlight.
It's the ultimate corporate plot twist, isn't it?
Mm-hmm.
In 2013, Dell Inc., a massive, globally recognized brand, executes a leveraged buyout and takes itself entirely private.
Which is almost unheard of for a company of that size.
Absolutely. And it was a direct reaction to what they called, and this is their term, bleak prospects.
Bleak prospects in 2013. I mean, what was the existential threat here? What was so severe that it required them to literally hit the mute button on Wall Street?
Well, the primary threat was the accelerating decline of the PC market. That, combined with the rise of mobility and, of course, cloud computing, Dell was still just so heavily reliant on selling PCs.
And their other offerings weren't quite there yet.
Their enterprise offerings weren't competitive enough, so they claimed they needed several years to completely overhaul their supply chains, to rationalize their product portfolio, and, critically, to shift their focus from consumer hardware to high-margin enterprise solutions.
And that's exactly where the public eye becomes an obstacle. I mean, if you need to spend 3 years making painful cuts in these massive, expensive internal investments that won't show a profit for maybe 5 years.
The public market will absolutely crush your stock price.
Of course.
Precisely. Quarterly reporting is a relentless master. When a company is public, any short-term volatility, even if it's for a good strategic reason, it's just viewed as weakness by shareholders.
So by going private, Dell essentially created a bunker for 3 years.
That's a great way to put it. From 2013 to 2016, they were free. They could restructure, they could make these long-term bets, divest unprofitable segments, and, crucially, strategize their next massive move, the acquisition, all without releasing a single quarterly financial result to public scrutiny.
It was strategic silence. They used it as a competitive advantage. It's really a textbook example of using financial structure to enable a massive operational change.
And while Dell was executing this corporate deep clean in the shadows, their eventual target, EMC Corporation, was dealing with a completely different kind of corporate chaos.
Public pressure.
Immense public pressure from activist investors who are demanding change.
Now, EMC was an enterprise giant, right? They were particularly dominant in the data storage market, but their internal structure, from what I've read, sounds incredibly complicated.
Oh, it was. It was known as the Federation structure. I mean, just imagine a corporate holding company where the divisions like EMC2 for storage, RSA for security, VMware for virtualization, and Pivotal for software were allowed to operate almost as independent fiefdoms.
So they had separate sales teams, separate R&D.
Often, yes. And they would even compete for the same customer wallets.
That sounds, well, wildly inefficient and just ripe for cannibalization. Why would a company intentionally create that structure?
The original intent, was to foster innovation and agility. The idea was to keep the subsidiaries entrepreneurial. But by the early 2010s, it had really become a liability. The market struggled to value EMC.
Because the whole was less than the sum of its parts.
Arguably, yes. And that's where the activist heat came in.
Okay, so who was applying that heat and what was their main argument?
The primary antagonist was the powerful hedge fund, Elliott Management Corporation. Now, they only held a relatively small stake, about 2.2% of EMC stock, but they were extremely vocal.
And what were they saying?
Elliott argued vehemently that the Federation structure was a mess. They said it was causing deep confusion, and specifically that it deeply undervalued EMC's crown jewels.
Which were?
Its core EMC2 data storage business, and of course, its majority stake in VMware.
So Elliott was basically saying, break up the family and release the value of the individual children?
Exactly that. They were demanding that EMC either reorganize, spin out major assets, or seek a full acquisition to unlock shareholder value. And the argument really gained traction. Analysts could clearly see that the internal competition, especially between EMC2's products and some of VMware's emerging offerings, was just muddling the message to the market.
So this combination of internal organizational weakness and external activist pressure, it created the exact vulnerability Michael Dell needed.
It's fascinating, isn't it? Both of these major players were simultaneously under immense pressure, just from completely opposite directions. Dell was retreating from public chaos, and EMC was collapsing under internal chaos.
And that convergence is why the deal made so much strategic sense.
And to really grasp the financial landscape that made that $67 billion price tag even possible, we need to compare their revenue strengths right before the acquisition was finalized. Let's look at 2014 estimates.
Okay, let's start with Dell. They were the volume player, right?
Right. Dell's estimated revenue was heavily weighted toward the front end. We're talking $27.3 billion from personal computers. That's huge volume, but often lower margin.
And servers?
About $8.9 billion from their foundational server products. They were, through and through, a hardware volume house.
Okay, so then EMC was the enterprise depth provider.
Yes, exactly. EMC's strength was in high-margin enterprise solutions and services. They reported $16.5 billion from their core data storage business, EMC2. They had another $6 billion from VMware, which was highly sought after.
And a couple of other pieces.
$1 billion from RSA Security, the crucial security division, and about $230 million from Pivotal Software.
So if you put them together, Dell brings the desktop-to-server connection and the huge global sales force that comes with that kind of volume.
Right.
And EMC brings the complex, high-margin enterprise software and storage needed to run massive corporations.
The strategy was crystal clear. Create a single vendor that could sell the entire IT stack, from the keyboard all the way to the core data storage array, all to one enterprise customer. Instead of selling servers and then having the customer go buy storage from a competitor.
They could sell the entire integrated solution.
That complementary fit was the fundamental justification for the immense debt they were about to take on.
Which sets the stage perfectly. They knew why they had to merge. Now we have to explore how they did it, which meant navigating, well, the largest debt load in tech history.
The announcement of intent came in October 2015. Dell was prepared to acquire EMC Corporation for an astonishing $67 billion. And this figure wasn't just big, it completely reset the bar for the entire technology sector.
Let's just pause on that figure for a moment. $67 billion. At the time of the announcement, this made it the largest acquisition in the history of the technology sector. It just eclipsed everything that came before it in tech.
It was a massive statement of intent, especially from a company that had only just emerged from its private life.
The sheer audacity of the move, you just can't overstate it.
You can't. And a move like this requires complete commitment from the major players. The source material confirms that Michael Dell, along with his key shareholders, Singapore's Temasek Holdings and the private equity firm Silver Lake Partners, were the major financial backers.
They were the ones staunchly supporting the deal.
They were the ones signing off on that immediate colossal debt.
And the deal closed relatively quickly, at least by M&A standards. September 7th, 2016, Dell Technologies, Inc. is officially formed. But its formation immediately came with a ticking clock.
Servicing the transaction cost.
Exactly. How much of that $67 billion price tag was actually financed through debt?
The transaction reportedly generated approximately $40 billion in debt for the new Dell Technologies.
$40 billion.
It's a liability that fundamentally dictates every single corporate decision you make going forward. It means the primary focus of the leadership, even ahead of innovation or market capture, had to be debt reduction.
And carrying $40 billion in debt isn't just about making interest payments. I mean, it restricts your ability to borrow more, it depresses analyst confidence, and it just generally suffocates your growth potential. So managing that debt wasn't a long-term goal, it was an immediate emergency.
Absolutely. The post-merger leadership had a crystal clear strategy, and it was rooted in the classic leveraged buyout playbook. You acquire the target, you separate the core assets from the non-core assets.
And you liquidate the non-core assets immediately to raise cash for the debt paydown.
Precisely.
Okay, let's detail those immediate financial maneuvers. Which divisions were deemed expendable in that initial fire sale?
We see three key yet sort of tangential divisions being sold off very shortly after the merger closed. They shed Dell Services, the Dell Software Group, and the Dell EMC Enterprise Content divisions.
Now, these were high-value assets, but I guess they were peripheral to the core strategy of selling integrated infrastructure and hardware.
That's it, exactly.
But selling the services and software divisions seems like a high-risk move. I mean, aren't services and software often the highest-margin businesses in technology?
That's a really perceptive question, and the answer is yes, they usually are high margin. However, the sheer pressure of that $40 billion in debt required them to prioritize speed. They needed immediate liquidity over long-term strategic depth in those specific areas.
So Michael Dell was making a very difficult trade-off.
A very difficult one. He was sacrificing non-core, high-margin future revenue streams to secure the financial stability of the core integrated hardware business today. They needed clean cash, and they needed it fast.
And what kind of cash did these strategic divestitures generate for the debt paydown? Was it enough?
The sources confirmed these sales were highly effective. They generated a total of $7 billion in proceeds.
$7 billion.
And critically, that $7 billion was used explicitly and directly to repay the principal debt. This maneuver signaled to the markets and to the remaining creditors that Dell was absolutely serious about reducing its leverage.
It was a significant reduction right out of the gate. A 17.5% reduction in the total debt load.
It was.
That's fascinating because they're simultaneously shrinking the company to pay down debt, yet they have to project confidence about future growth to justify the initial acquisition in the first place.
And that tension is where the strategic brilliance lies. They executed the necessary, painful, short-term debt management, but they quickly followed that up with a massive signal about their long-term vision.
Right.
The sources report that in October 2017, just over a year after the merger closed, Dell announced this big forward-looking investment, $1 billion over 3 years dedicated specifically to Internet of Things, or IoT, research and development.
That simultaneous action is incredible. It's like selling $7 billion worth of furniture to pay the rent and then immediately signing a $1 billion check for a major home renovation. It's extremely high confidence.
It is.
Why IoT specifically?
Well, IoT was, and still is, a critical future growth vector. It requires massive back-end infrastructure servers, storage, networking, all of which Dell Technologies was now perfectly positioned to sell, thanks to the EMC merger.
So by earmarking $1 billion for IoT, they were telling the market something very specific.
They were telling the market, we are not just a debt-saddled collection of old businesses. We are investing heavily in the future data-driven economy. And this aggressive investment helped reset the narrative away from pure debt management toward future opportunity.
It effectively showed the market that the debt paydown wasn't an end in itself. It was a means to an end, a way to fund their strategic pivot. They achieved stability and then immediately committed capital to growth.
Correct. But this entire financial ballet, particularly the way they incorporated the EMC assets, introduced a new level of complexity. And it was all centered around one of the most valuable parts of the acquisition, VMware.
Ah, yes.
This complex relationship with VMware is what ultimately paved the way for Dell's non-traditional return to public life.
Which means we need to talk about tracking stocks.
When Dell acquired EMC, they didn't just get hardware and enterprise software. They gained control of VMware, which was the leading company in server virtualization and, importantly, was already publicly traded.
And what was the ownership structure before the deal?
EMC owned approximately 80% of VMware stock before the acquisition. VMware was this independent, highly successful entity with its own public shareholders. So the challenge for Dell was how to integrate EMC without collapsing VMware's existing public structure and its enormous value.
So they needed to merge the two parent companies without actually merging the subsidiaries entirely. How did they achieve that structural miracle?
They turned to financial engineering. They employed what you just mentioned, tracking stock. When Dell Technologies was formed, that 80% stake in VMware that EMC held was packaged up and distributed to the former EMC shareholders.
In the form of this new tracking stock.
Yes, often referred to as Dell Technologies Class V shares.
Okay, let's break down tracking stock with the clarity our listeners need. How does it function, and why was it so essential here?
Well, a tracking stock is a specialized class of common stock. It's issued by a parent company, in this case Dell Technologies, that is designed to track or reflect the financial performance of a specific subsidiary. Here, that was VMware.
But it doesn't give you direct ownership in that subsidiary.
Exactly. It doesn't confer direct legal equity ownership. Think of it this way.
Ugh.
It's like a coupon or a certificate that promises to pay out based on the profits of a specific restaurant, but it doesn't actually give you ownership of the restaurant's kitchen or building.
So if VMware's stock went up, the value of the Dell tracking stock also went up. This allowed former EMC shareholders to maintain their exposure to VMware's growth, but they were technically shareholders of the new parent company, Dell Technologies.
Precisely. The maneuver was brilliant. It allowed Dell to claim ownership and strategic control of the 80% stake in VMware, integrating it into the new Dell Technologies structure while keeping VMware's operational identity separate.
And it appeased the former EMC shareholders who really valued their investment in the profitable virtualization firm.
It did. But this complex financial structure had an unintended side effect, didn't it? It forced Dell to undo the very reason it went private back in 2013.
How so?
Well, the acquisition of EMC meant Dell now controlled a company, VMware, that issued a public tracking stock.
Yeah.
Because Dell Technologies was issuing a security that tracked the performance of a public entity, they triggered regulatory requirements.
Ah.
They were once again required to file public financial statements and publish quarterly results. The strategic silence that they purchased in 2013 was over.
So the tracking stock wasn't just a financial instrument. It was a bridge back to the public market. And that brings us to the formal second act, the decision to go fully public again.
The initial whispers started in early 2018. Dell Technologies was reportedly considering a way to leverage its VMware stake to take the entire parent company public. One of the highly rumored paths was a reverse merger.
A reverse merger. It sounds like a very corporate way of doing things backward.
It is, really. A reverse merger is essentially when a private company merges into a much smaller, already public shell corporation to quickly gain public status. It lets you bypass the expensive and time-consuming scrutiny of a traditional IPO.
And in Dell's case, the shell would have been their own public subsidiary, VMware?
It would have been, but they ultimately chose a slightly different, equally unconventional path, one that still leveraged that tracking stock.
Right.
So in December 2018, Dell Technologies officially returned to the public markets, but they did so by bypassing the traditional IPO process entirely. Instead of issuing new shares to the public in a big roadshow, they executed a buyback of the very instrument we've been discussing.
The tracking stock shares. They bought back their own coupons. How did that make the parent company public?
They offered a mix of cash and stock in the parent company, Dell Technologies, to the tracking stockholders in exchange for their Class V shares. By retiring those tracking shares, the parent company, Dell Technologies, Inc., effectively went public.
And the existing Dell shareholders, Michael Dell and Silver Lake, they just converted their shares into the new publicly traded parent stock.
Exactly. It was a clean, rapid way to monetize the company and provide liquidity without the unpredictability of a full IPO.
It's a remarkable piece of financial maneuvering, using the complexities of the acquisition structure itself to facilitate the eventual exit strategy. 6 years after going private to hide from the public market, they used this reverse mechanism centered on their acquisition to re-enter it, now as a far larger and more diversified entity.
But the journey wasn't quite complete. Even though Dell Technologies was now publicly traded, they still owned the vast majority of VMware. That relationship continued until the final, definitive separation.
When did that happen, and why was it necessary?
The final financial separation was reported in April 2021. Dell Technologies executed a spin-out of the remainder of its VMware shares, distributing them directly to Dell Technologies shareholders.
So that simplified Dell's structure.
It did. And it unlocked billions of dollars in shareholder value, and it eliminated any remaining entanglement from the tracking stock era.
But you mentioned it wasn't a hostile breakup. They spun out the shares, but the relationship continued.
And that's the critical detail. While financially distinct, the two companies signed an agreement. It committed them to continue operating without major changes and maintaining a strategic partnership for at least 5 years.
And that ensures Dell Technologies can continue to sell tightly integrated joint solutions like servers bundled with virtualization software to their enterprise customers.
All without the market confusion of shared ownership.
The narrative arc here is just stunning. You have strategic privacy, an elephant-sized acquisition, massive debt restructuring, this financial bridge via tracking stock, and then a clean spin-out. It's truly a masterclass in corporate restructuring.
And it moved them from a PC vendor to what they are today. And that pivot, the definition of the modern Dell Technologies, is exactly where we need to focus now. What did all this financial maneuvering actually build?
Okay, let's look at the company that emerged from this chrysalis of debt and divestiture. Dell Technologies today is primarily organized into two enormous segments. Which one still brings in the majority of that $95.6 billion in revenue?
That would still be the Client Solutions Group, or CSG. It represents the legacy, high-volume Dell business, focusing on the end-user device. For fiscal year 2024, CSG accounted for the majority of revenues, 55.3% of the total.
So over half their revenue still comes from the business they tried to escape a decade ago. That just speaks volumes about the sheer scale and global necessity of personal computers and devices.
Absolutely. CSG is the consistent cash engine. This group is responsible for producing desktop PCs, notebooks, tablets, and essential peripherals like monitors, printers, and projectors, all under the well-known Dell brand.
Let's talk product lines. If someone is listening on a Dell machine right now, which product family are they most likely using?
On the consumer and gaming side, you've got the high-performance lines. There's Alienware, which Dell maintains as a subsidiary, focused purely on gaming. Right. Then there's a general consumer line, Inspiron, and the premium thin and light laptop line, XPS, which competes directly with Apple and other high-end Windows manufacturers.
And what about the enormous business market? That's where the high volume of corporate purchases comes in.
The business side is the core bread and butter for CSG volume. They sell the Vostro and Optiplex lines for business desktops, the Workhorse Latitude line for corporate notebooks, and the powerful precision workstations for engineers and designers.
And the key for CSG today isn't just volume, right?
No, it's embedding features, things like advanced security and increasingly AI processing capabilities into these devices to keep them relevant in the modern workplace.
So CSG is the stable foundation. Now let's turn to the reason for the $67 billion merger, the enterprise future, embodied by the Infrastructure Solutions Group.
That would be the Infrastructure Solutions Group, or ISG. This is the company Dell wanted to become. ISG is entirely focused on the enterprise data center and IT infrastructure. It covers servers, storage, and networking.
And in FY 2024, ISG contributed, what, 38.3% of total revenues?
That's right. And even at 38.3%, that is still tens of billions of dollars in revenue generated by high-end enterprise solutions.
What are the flagship products driving ISG sales?
This is where you really see the fruits of the EMC acquisition. The primary driver is their server line, PowerEdge, which is one of the most deployed server architectures globally.
And for storage?
For data management, they offer the mid-range storage line, PowerVault, alongside high-end systems that inherited that EMC legacy. And of course, there's a comprehensive suite of networking solutions under Dell Networking.
You mentioned scale-out architecture and converged infrastructure in the outline. We should probably be specific about what those terms mean for a listener who isn't living in a data center.
That's a crucial distinction. Converged infrastructure means selling pre-integrated bundles. So instead of a client buying servers from Dell, storage from NetApp, and networking from Cisco,
Dell sells them a single, factory-tested rack that contains all of it, managed by a unified software layer.
Exactly. It simplifies IT purchasing and deployment immensely. It's a one-stop shop for building a private cloud.
Okay, that makes sense. And what about scale-out architecture?
That addresses how they design those systems. So traditional architecture might rely on one massive, expensive server that's difficult to upgrade. That's called scaling up. Scale out means using many smaller, standardized, cheaper servers that you can easily add or scale out as your capacity demands grow.
So clients can build large, flexible, private cloud environments that mimic the economics of public cloud providers, but on-premise.
Precisely. They leverage the EMC merger to move from selling boxes to selling entire pre-integrated data center solutions.
And interestingly, nearly half of this massive operation is focused domestically.
Yes, the financial reports confirm that. Approximately 50% of the company's total revenue is derived right here in the United States. While they are a global multinational, their foundational customer base and revenue stability are heavily weighted toward the domestic North American market.
Now let's pivot entirely to the future. If Dell successfully transformed from a struggling PC maker to an enterprise infrastructure powerhouse, where are they betting their R&D dollars right now? What's the current strategic focus?
The focus is overwhelmingly on future data processing paradigms. We're talking cloud, edge, and artificial intelligence. Dell Technologies knows that the $67 billion investment only bought them a seat at the table.
Staying relevant requires them to lead in these three integrated areas.
Right.
Let's start with edge computing, a term that gets thrown around a lot.
Hmm.
How is Dell defining its role at the edge?
Dell views the edge as where data is generated and acted upon. So outside the traditional centralized data center or public cloud, this could be a factory floor, a retail store, a remote hospital,
Or a self-driving vehicle.
or a self-driving vehicle. Their strategy is to offer integrated compute, storage, and networking that is specifically ruggedized and streamlined for those environments.
Why is that necessary? Why can't a factory just send all its data to the cloud?
Because of latency and volume. In a manufacturing plant, if a machine needs to stop instantly because a sensor detected a fault, you can't wait the milliseconds it takes to send the data to a cloud server miles away and get the command back.
Edge computing allows for low latency, real-time decision-making locally.
Exactly. And Dell is targeting this massive growth area by offering specialized, compact, often industrial-grade solutions optimized for this decentralized processing.
That's a highly specialized market.
Sure.
And how does AI factor into both their edge and their core infrastructure solutions group business?
AI is now integrated across their entire product stack, from client devices all the way up to high-end servers. At the ISG level, Dell is focusing on building and selling AI server clusters.
So highly optimized racks of servers.
Right, often using specialized hardware like NVIDIA GPUs or custom AI accelerators. They're designed specifically for training and running large language models and other complex AI workloads. They are providing the physical backbone for the AI revolution.
So if a company is building its own internal GPT model, they're probably buying Dell PowerEdge servers configured precisely for that purpose.
Exactly. They aren't just selling servers. They're selling AI-ready infrastructure solutions. Then, if you look at the CSG level, they're embedding AI there too. New laptops and desktops are coming with neural processing units, or NPUs.
Dedicated chips for AI tasks.
Yes, dedicated chips designed to handle low-level AI tasks like optimizing video conferencing, background blurring, or running basic local generative AI features, all without relying on the cloud or consuming excessive battery life.
That is the ultimate strategic alignment. Selling the AI infrastructure, the ISG, that powers the models, and then selling the AI endpoints, the CSG, that use the models.
And this strategic vision is backed by stable, long-term leadership. I mean, despite all the complexity of the public return, Michael Dell remains firmly in charge. He retains significant ownership, 58.9% as of February 2024. He's still the controlling voice, ensuring the long-term vision stays intact.
We also see them continuing to refine the business. Even after the massive merger and spin-out, it suggests the streamlining process never really ends.
That's a key point. Just recently, in February 2025, they continued their strategy of focusing on the absolute core by selling SecureWorks, a cybersecurity subsidiary, to the British vendor Sophos.
So it shows that even services, if they aren't tightly integrated into the core infrastructure offerings, are still potentially expendable for capital management and focus.
I think so.
Before we wrap this section, let's return to that real-world application, that fantastic detail about the 2018 racing partnership with McLaren.
That is such a strong visual of their ISG capability. Formula One racing is a real-time data nightmare. You have massive amounts of sensor data just pouring in constantly. Tire wear, engine temperature, aerodynamic forces.
And decisions have to be made with near zero latency.
So Dell provided the processing power and infrastructure to support McLaren's Formula One program. They were essentially using the race team as an incredibly intense stress test for their PowerEdge servers and data storage solutions.
The lesson there is pretty clear. If their tech can handle the data requirements for a Formula One team making critical decisions at 200 miles an hour, it can probably handle your enterprise database.
It demonstrates the performance, the reliability, and the scale of the Infrastructure Solutions Group in the most high-stakes, demanding environment imaginable. It solidifies their image as a serious, modern enterprise player.
Far removed from the struggling PC company of the early 2010s, we have certainly covered the transformation, the financial maneuvers, and the current product structure, all pointing toward a highly successful corporate pivot. So what does this entire complex journey of Dell Technologies mean for you, the learner? The story is really a textbook case study, a masterclass, if you will, in how a massive corporation can use financial engineering to execute a complete identity change.
We saw Dell go private to escape the market pressures that were stifling their restructuring efforts. They used that strategic isolation to plan and then execute the $67 billion acquisition of EMC, the largest in tech history at the time.
And that fundamentally shifted their focus from client devices to enterprise infrastructure.
It did.
And crucially, they managed that massive $40 billion debt burden by immediately shedding $7 billion worth of non-core assets, proving they were willing to make painful, strategic sacrifices for long-term stability.
They leveraged complex instruments, particularly that tracking stock, to facilitate the acquisition. And then they engineered an unconventional rapid return to the public market by buying back that same tracking stock, bypassing the burdens of a traditional IPO.
And the ultimate result is a company that has successfully modernized its identity. While the Client Solutions Group still provides the stable volume, the future is clearly defined by the Infrastructure Solutions Group and its aggressive focus on integrated solutions for the new data economy.
AI, edge, and cloud computing.
All of it.
I think the key takeaway here is the demonstration of strategic agility married to financial resourcefulness. This scale of transformation requires not just technological foresight, but the ability to use complex financial structures, that high-wire act with the tracking stocks and the decisive debt management, to pivot the company from a manufacturer of PCs to a comprehensive enterprise infrastructure leader.
It was a strategy executed with precision.
And based on their near $100 billion revenue, it paid off spectacularly.
It did. But we can't end this deep dive without returning to the most provocative detail hiding in the financial statements, a detail that really challenges our standard understanding of corporate health.
Yes. Despite its immense size, its $95.6 billion in revenue, and its significant market value, the Dell Technologies balance sheet reports a negative total equity of negative $1.5 billion as of fiscal year 2025.
Negative equity. For a listener who typically sees equity as a sign of health and ownership, how can a Fortune 500 company, an industry leader, maintain immense scale and stability while carrying negative equity?
It raises a profound question about the nature of modern leveraged finance. Negative equity essentially means the company's total liabilities outweigh its total assets based on accounting value, or book value.
Which is a common outcome of these large, highly leveraged buyouts.
Exactly. Like the one that took Dell private and then fueled the EMC merger. The debt taken on to execute the deal is so massive that it permanently depresses the book value of the company's equity.
So it's not necessarily a sign that the company is failing, but rather a permanent accounting scar from the historical financial engineering.
Precisely. It tells us that Dell's market value, the price its stock trades at, is based entirely on investor confidence in its future earnings potential in AI, edge, and infrastructure, rather than the historical accounting value of its physical assets minus its staggering debt load.
So it encourages you, the learner, to deeply analyze the specifics of large-scale corporate balance sheets and to understand the distinction between accounting principles like negative book equity and real-world market valuation for highly leveraged tech firms.
A company that defied expectations by going private, executed a record-breaking acquisition, and now operates with negative equity while leading the AI infrastructure race. That is the Dell Technologies story.
Thank you for diving into this dense and fascinating history with us.
Keep learning.